to Iron Financial, the only explainer you need to forge a stronger portfolio and cut straight through market weakness. I'm your lead analyst, and today we are looking at a company that is quite literally welding the foundation of the AI revolution. Look, the artificial intelligence infrastructure boom is absolutely tearing up the market right now. But here's the reality. If you want to know if this entire sector is built of solid steel or just cheap tin, you have to look directly at the suppliers bearing the load. So today, we are putting CoreWeave's Q1 2026 earnings through the ultimate stress test. This is the hypergrowth darling of the cloud compute world, and these numbers, they aren't just a standard earnings report. They are a blueprint for the future of global tech infrastructure. We're going to drill down deep into the revenue, the massive debt, and the margins to see if this is a company you actually want to anchor your long-term portfolio to.
Before we even open the ledger, let's establish the sheer stakes of what we are dealing with. Going into this earnings report, the options market priced in a massive 17% implied volatility swing. Now, for a stock hovering right around $125 a share, that is a seismic expected move. It's huge. And consider the momentum leading into this. CoreWeave has already climbed 75% year to date. Keep in mind, this stock has completely doubled since its initial public offering in March of 2025. When a multi-billion-dollar tech giant is expected to swing nearly 20% in a single day, it tells you that Wall Street is literally sitting on the edge of its seat. The market is pricing in either a monumental structural breakthrough that cements their dominance forever or a catastrophic failure in their financial architecture.
Right, and that's exactly where I step in. I'm the market skeptic, and I'm here representing you, the viewer. My job is to ask the hard questions. Is this hyper-growth tech darling actually laying a solid foundation, or is this just another massive pile of market hype that's eventually going to crumble under its own weight? A 17% implied swing means nobody actually knows if the math checks out behind closed doors. We hear a lot of noise about AI infrastructure, but, when you build skyscrapers this fast, you usually leave a few bolts loose. Today, we are bringing the magnifying glass to every single joint and weld. I want to know if the cash flow is real, or if they are just burning massive amounts of capital to buy the illusion of growth. Lead analyst, show me the heavy lifting. Let's see if the cash is actually there. Oh, trust me, the heavy lifting is absolutely getting done. Let's dive into the top-line numbers, because they are nothing short of explosive. In Q1 of 2025, CoreWeave pulled in $982 million in revenue. Fast forward exactly 1 year to Q1 2026, and they have more than doubled that, posting a staggering $2.078 billion for the quarter. To put that into perspective, Wall Street's consensus estimate was hovering around $1.97 billion. CoreWeave completely crushed it. We are looking at year-over-year top-line expansion that surpasses 100%, literally 100%. Outside of the absolute bleeding edge of the AI infrastructure sector, you simply do not see companies at a multi-billion-dollar scale doubling their top line in a 12-month window. They are converting scarce, highly coveted AI infrastructure into raw revenue with ruthless efficiency.
But listen, it's not just about top-line vanity metrics. It's about the underlying profitability that proves the business model actually works under pressure. Let's break down the adjusted EBITDA, which came in at $1.157 billion. That translates to a phenomenal 56% adjusted EBITDA margin, meaning before all the accounting magic, they are keeping more than half of every single dollar they make. This is a business with incredible pricing power and massive operating leverage. And if you want to talk about raw cash generation, consider their operating cash flow for the quarter, $2.984 billion. That is nearly $3 billion in net cash provided by operating activities in a single 3-month window. This isn't theoretical paper wealth. This is heavy, dense cash generation that gives them the capital to keep laying down new server infrastructure without having to sit around and wait on the sidelines.
And here is the metric that truly forms the bedrock of their long-term growth. $99.4 billion. That is their revenue backlog as of March 31st, 2026. Just 3 months prior, at the end of 2025, that backlog was sitting at $66.8 billion. They added over $30 billion to their backlog in a single quarter. This represents massive, contracted future business. This isn't a pipeline of maybe deals or gentle handshake agreements. These are legally binding commitments to deliver compute power. This $99.4 billion is the ironclad guarantee that future cash flow is locked in, providing the ultimate structural reinforcement for everything else they're building. So, you might be wondering, who exactly is signing these massive contracts? Let me break down the whales driving this backlog, because the names tell a really powerful story. You have Meta committing a mind-bending $21 billion to CoreWeave to fuel their open-source models. You have Jane Street, the quantitative trading powerhouse, stepping up with a $6 billion commitment to maintain their trading edge.
And you have multi-year agreements with leading AI labs like Anthropic to deploy their Claude models at scale. CoreWeave now has 10 different customers committed to spending over $1 billion each. And what's truly bullish, what really signals their market dominance, is that average pricing for older generation chips, like the A100, actually increased in 2025. And H100 pricing is holding completely stable within 10%. The demand is entirely outstripping the market supply, and CoreWeave is capitalizing on every single inch of it.
This scale is honestly almost hard to comprehend, which is why I want to bring in this quote from CEO Michael Intertor. He stated, "We surpassed 1 gigawatt of active power and believe we are well on our way to more than 8 gigawatts by 2030. Guys, 1 gigawatt is enough power to run a medium-sized city, and they are using it strictly for raw compute power. And here is where the structural lock-in happens. Over 90% of their reserved instance customers use at least 2 of CoreWeave's products, and 75% use 3 or more. Customers aren't just renting graphics processing units for an afternoon, they are relying on CoreWeave for enterprise-grade storage, CPU, and advanced networking. Once these clients weld themselves to the CoreWeave ecosystem, the switching costs are simply too high. They just do not leave."
Okay, let me jump in here. It's a great victory lap, and the top-line numbers are certainly shiny. But every towering skyscraper casts a very long, very dark shadow. I want to aggressively stress test these financials because you're painting a picture of total invincibility. If this company is generating so much cash and locking in $100 billion backlogs, then why is the options market pricing in a 17% volatility swing? The market senses danger beneath the surface. I demand we look under the hood. What does it actually cost to build this massive infrastructure? Let's search for the cracks in the armor, because no hypergrowth story is ever this perfectly clean.
Because here is the first massive glaring crack. You bragged about the $2.078 billion in revenue, but you completely glossed over the bottom line. CoreWeave posted a GAAP net loss of $740 million for Q1 2026. That is a 36% net loss margin. Let that sink in for a second. They brought in $2 billion and they lost $750 million doing it. Furthermore, this is drastically worse than the same time last year. In Q1 of 2025, their net loss was only $315 million. So as revenue doubled, the raw dollar loss more than doubled. In fact, they missed Wall Street's profitability estimates entirely, coming in with a 1.12 adjusted loss per share against an estimated 90-cent loss. The structure might be growing, but they are bleeding heavily just to keep the lights on. Let's hammer down exactly where this cash is bleeding out. CoreWeave recorded a staggering $2.222 billion in operating expenses for a single quarter. To support this relentless growth, their corporate bloat and infrastructure scaling costs are absolutely skyrocketing. But the number that truly terrifies me, that would be the $536 million in net interest expense. $500 million just to service the interest on their loans for 3 months. That isn't building new servers, that is just keeping the bankers happy. I really have to question if this financial foundation can actually support this much dead weight. When your interest expense equals a quarter of your total revenue, you are playing a very, very dangerous game of leverage. And speaking of leverage, let's examine the balance sheet. In Q1 alone, their capital expenditures, meaning the actual money spent to buy property and equipment, was $7.695 billion. To fund that massive capex, they have piled on a staggering debt load. As of March 31, they hold $7.547 billion in current debt and $17.312 billion in non-current debt. That is roughly $24.8 billion in total debt. Now compare that to their total stockholders' equity, which sits at only $4.759 billion. This is a highly, highly leveraged structure. If AI demand ever softens, or if their clients delay a payment, this isn't just a minor bump in the road. This is a potential debt trap that could collapse the whole company.
All right, hang on. I need to step back in and correct the narrative here, because you are completely misunderstanding the structural engineering of their financing. Let's talk about the new $8.5 billion delayed draw term loan, or the DDTL 4.0 facility. This is literally a first-of-its-kind financing vehicle in the tech world. It achieved an A- equivalent investment grade rating from Moody's and Fitch. Why? Because the facility is non-recourse to the parent company. This means if things go south, the bank takes the specific server assets, not the whole company. It is backed directly by the high-performance computing infrastructure and those ironclad customer contracts we talked about earlier. And it's priced incredibly well.
a fixed rate tranche at approximately 5.9%. This isn't some toxic debt trap. This is a brilliant structural shift in how they efficiently finance immense growth using asset-level collateral.
And if you still doubt the structural integrity of this business, consider who is providing the equity. CoreWeave just closed a massive $2 billion Class A common stock investment directly from NVIDIA. NVIDIA isn't just their supplier, they are an equity partner deeply invested in CoreWeave's long-term success. With this capital, they have expanded their partnership to accelerate the build-out of more than 5 gigawatts of AI factories by 2030. Their total property and equipment assets have now hit an incredible $36.424 billion. So that debt you are so worried about, it is directly tied to hard, revenue-generating physical assets that the biggest companies in the world are lined up around the block to lease. Well, that all sounds very sophisticated, but let's actually analyze the cap table to see who is carrying the heaviest load if this structure does crack. If we look at institutional ownership, Vanguard maintains the largest stake at about 5.84% across its funds. Board member Jack Hogan holds 3.42%. But consider the massive slice of this pie. Public corporations and retail investors collectively control nearly 75% of CoreWeave's equity. This means everyday traders, the people watching this explainer right now, are the ones holding the bag. The institutional whales are hedged, they have their safety nets, but retail is highly exposed to this hyper-growth, debt-heavy experiment. If the blueprint fails, it's the everyday portfolio that takes the structural damage. But look at Wall Street. The institutional analysts who scrutinize these blueprints for a living, they are actively ignoring the debt fears because the math fundamentally works. Consider Jefferies. Ahead of this earnings report, they didn't just hold their rating. They aggressively raised their price target from $120 to $160 a share, maintaining a solid buy recommendation. The broader street consensus target is sitting at $133.21. Out of the 15 major analysts covering this stock, there are 11 buys, 4 holds, and absolutely 0 sell ratings across the board. 0! The smart money recognizes that while the upfront capex is extremely heavy, the lifetime value of these multi-billion-dollar contracts far, far outweighs the debt service costs.
Okay, it's time for the verdict. When we put all this data into the furnace, what comes out? From the bullish perspective, you have an ironclad $99.4 billion backlog. You have $2 billion in fresh backing from NVIDIA, and you have nearly $3 billion in operating cash flow, proving that the core operations are highly profitable. This backlog virtually guarantees future cash flows.
Right. And the bear case is that you can't outrun financial gravity forever. CoreWeave has built a $36 billion infrastructure empire on the back of nearly $25 billion in debt. They are taking a massive GAAP net loss of $740 million, bleeding over $500 million in interest expense alone. If the AI music ever stops, this company is left holding a phenomenally expensive bag of depreciating hardware.
So there you have it, folks. We've laid out the blueprint. We've tested the steel, and we've exposed the leverage. Now the final decision is entirely in your hands. Are you going to weld this hyper-growth, high-margin AI powerhouse into your portfolio, trusting that the $100 billion backlog is an unbreakable fortress?
Or you got to walk away from a company bleeding hundreds of millions in interest, recognizing that a $24 billion debt load might just be a structural liability waiting to snap under pressure?
Let us know what you think in the comments. Thanks for tuning in to Iron Financial. Keep your portfolios forged, stay sharp, and we'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.